You've heard about the benefits and risks of using a credit card, and you're feeling pretty confident, right? Well, if you want to get the most out of your credit card, there's another thing you need to know about: finance charges. These are the fees that a lender charges you in exchange for the ability to make purchases with your card. There are several kinds of finance charges, but the most important is your interest rate. This is the yearly interest that's applied to your balance. Your interest rate is a set rate that doesn't normally change. If it does, your credit provider is required to notify you. What can vary is the method by which your interest rate is applied. But the critical part is your balance calculation. Your provider uses a balance calculation to determine the rand amount your interest rate will be applied to and how. There are 3 common ways that lenders calculate your balance. Many use an average daily balance, others use your previous month's balance, while some use your average daily balance over 2 months. Make sure that you read your terms and monthly statement to understand what you are being charged. Now, aside from your interest rate and balance calculation, there's another thing that can really affect your finance charges: compound interest. Some lenders charge you compound interest if you pay late or if you only make the minimum payment each month. To understand compound interest, let's say you spend 1,000 Rand to replace a flat tire and you only pay a minimum of 250 Rand, leaving you with a balance of 750 Rand. At the end of the month, your interest charge will be applied to the remaining balance of 750 Rand. Depending on your interest rate, it may not seem like much. But let's say you're being charged 30 Rand of interest, bringing your amount due to 780 Rand. The next month, because of compound interest, your interest isn't calculated based on the 750 Rand balance, but your new balance of 780 Rand plus any additional purchases you may have made. This is what we mean by compound interest, or interest on top of interest. And it keeps calculating, whether you make a new purchase or not. So even if you didn't buy anything new, you'll still see the interest adding up on your total balance each month until you paid off entirely. This is how banks and financial service providers can make a lot of money. And for you, that tire can get expensive very quickly, which is why it's so important to pay in full each month within your grace period. That is the time between the end of your billing cycle and your due date. The differences in terms from one credit card to another might seem subtle on paper, but they can have a big impact in real life, which may lead to higher interest charges, higher bills, and less available credit. If you master those details, you will not only save money on interest and fees, you could also have more available credit to pay for unexpected life events like medical emergencies and have more money for long-term goals like a nicer home or a car. So do your research and understand your terms. It will help you become a true master of your financial health.